Hi everyone, so today I'm with Dom and we are going to be doing a new video, a stock analysis video on a company called Netskope. And Dom is going to talk about the company analysis and the earnings, and then afterwards I'm going to talk about the financials. So Dom, whenever you're ready, please take it away.
Thank you, Matt. All right. Can you see my screen?
Yeah, perfect.
Cool. So today we're talking about Netskope. So can I go over a little bit about them? So first things first, they were founded in 2012 uh, in Santa Clara, California. They did have some other milestones, but we'll kind of pass through those for now because we're more interested in the 2025 one, which is IPOing in August, or excuse
Mhm.
me, IPO filed in August but listed in September. So what do they actually do? So they are a security cloud platform that offers visibility into application usage, advanced threat protection, and compliance support. And then they actually, surprisingly, impressively, protect thousands of organizations worldwide, including 30 of the Fortune 100 companies. So not too shabby. So let's kind of go into a little more about what they actually kind of provide and then how they make money. So they have cloud native architecture, which they say is built for SaaS, LaaS, and cloud storage adopters. They have data protection through advanced DLP, and they say that is called data loss prevention and encryption. They have threat detection, which is AI-driven threat protection across cloud and endpoints. SAE or SASE framework, which integrates networking and security into one cloud delivered service. They have a zero trust model. They say is continuous identify and context based authentication,
Mhm.
so less people getting in when they shouldn't be. And then their global footprint, they say, is more than 60 data centers across America, EMEA, and APAC. So not too bad either. So pretty good size. Um, so now, how do they actually make their money? So they have four primary ways that they make their money. So first is subscription licenses, which is recurring revenue from enterprise purchasing multi-year contracts for security cloud. They have professional services, so you can consider this something like consulting, implementation, and integration of services for large-scale clients. They have a partnership program or a partnership ecosystem where they're revenue sharing through alliances with global integrators like Accenture and Deloitte. Hope those are pronounced correctly. And then training and certifications are the final main way, which is where they have like a online learning academy for programs for IT teams, and they help create auxiliary revenue stream through that as well. And then like most companies, they always try to upsell stuff, and so they do also mention that they leverage an upsell model where customers start with CASB or Secure Web Gateway Services, and then expand to their full SASE and Zero Trust packages. So they do actually have quite a bit of different ways where they can earn revenue, which is kind of nice. This article does state that the company reports high net retention rates, including customers often spend more overtime when doing these types of things. So good to see. Oh, one last thing I also want to mention before we flip to the earnings report, that they do say that even though they do have all these different ways of earning revenue, that the model does ensure predictable recurring revenue, though profitability has yet to be achieved due to high research and design and sales spending. So something to keep in mind. So let's scoot over and we'll talk about the third quarter year 2026 financial results and dive into that. So first things first, annual recurring revenue grew 34% year over year to 754 million as of October 31st, 2025. So it's pretty good. Revenue for Q3 was at 184.2 million, an increase of 33% year over year.
Mhm.
Gross profit and margin, GAAP gross profit was at 106.6 million compared to 91.8 million for the third quarter of fiscal 2025, and GAAP gross margin was at 58% compared to 66% for the third quarter of 2025. Non-GAAP gross profit was at 137.6 million compared to 97.5 million for third quarter 2025, and non-GAAP gross margin was 75% compared to 70% for the third quarter of fiscal 2025. Non-GAAP gross profit excludes 28.6 million stock-based compensation expense and related tax, compared to 0.6 million in the prior year period, primarily due to the vesting of certain equity awards in conjunction with the initial public offering. So overall, not too bad. They do have some loss, so to say loss from operations and operating margin. So they have GAAP loss from operations at 447 million compared to a loss of 53.8 million for the third quarter of fiscal 2025, and GAAP operating margin was at 243% compared to 39% for the third quarter of fiscal 2025. Non-GAAP loss from operations was 28.2 million compared to a loss of 35.5 million for third quarter of 2025, and non-GAAP operating margin was 15% compared to 26% for third quarter of fiscal 2025. 2025. Non-GAAP loss from operations excludes 416.2 million in stock-based compensation expense and related taxes, compared to 12.3 million in the prior year period, and due to primarily to the vesting of certain equity awards in conjunction with public offering. Net loss per share, they are saying was at $1.85 compared to 72 cents in the third quarter of fiscal 2025. Non-GAAP net loss per share was at 10 cents compared to the 37 cents in the third quarter of fiscal 2025. Non-GAAP net loss per share excludes 4 cents of the loss of the change in the fair market value of convertible notes compared to 18 cents in the year ago period. As of October 31st of this year, the weighted average common stock outstanding was 245 million, and the fully diluted share count under the treasury stock method was approximately 506 million. Okay, let's go to cash flow, one of our favorites. So net cash generated from operations was 11.2 million compared to 10.9 million used in operations in the third quarter of fiscal 2025, and operating cash flow margin was 6% compared to 8% in the third quarter of fiscal 2025. Free cash flow was 10.6 million compared to 28.6 million in the third quarter of fiscal 2025, and free cash flow margin was positive 6 cents compared to 21% in the third quarter of fiscal 2025. So cash margin is down a little bit compared to last year. Cash equivalencies, and marketable securities. Total cash, cash equivalencies, and marketable securities at the end of third quarter end of the third quarter was 1.2 billion. So overall, a little bit of a mixed quarter, some positive, some negative, but overall, I wouldn't say too bad. The rest of the article just kind of talks about more about the company itself, so it's not painting too much about the quarter results. But overall, like I said, a little bit mixed, but not too bad. So we'll kind of switch it over to Matt, and he'll kind of go over the financials, and we'll see how those are looking.
All right, thank you, Dom.
Thank you.
All right, so great earnings, of course, and really good free cash flow growth. You have 12 million right now, and in the future, 80 million. So can't beat that. Of course, earnings are negative. They're not profitable yet. Be aware. Like Dom was saying, you do have to be a little bit careful of that, but free cash flow growth, really, really good for that. Can't complain. The financial health actually made quite a recovery this quarter. Before it was not great, and now it is okay, I would say. You have debt, you have the equity finally positive. Cash is higher than the debt, and I think the equity will eventually be higher than the debt, and the debt will start coming down a little bit. So I think it's certainly improving than what it was before, which was negative equity. It was negative shareholders' equity. It was very bad. That means the company is not financially stable at all. Oh, there's Jensen Huang. But regardless, we'll switch over to the next one because I was done with that anyway. And we are going to see that, unfortunately, since this company is new, there is no DCF yet that you can calculate, even with relative valuation Wall Street price targets. So we'll just go right ahead to Tipranks, and Tipranks is going to say that, gotta reload it. Tipranks is gonna say it's a strong buy, 15 buys on the stock, and it's about 42% upside. So the company overall looks really, really good, I would say. But you need to be careful because it just IPO'd like 3 months ago. And generally, I don't like buying IPOs because they're usually high risk because, again, there's no valuation yet. And it's very hard to judge, if it's over or undervalued. So you do have to be a little bit careful because it's high risk, high reward, definitely with this. But I would say that you should definitely keep this on your watch list because there's high potential for really just a great return in a great company that's going to happen. Dom, is there anything you wanted to add?
Nothing too much, but I did want to also just reemphasize the fact that since it recently IPO'd, to be extra cautious, just because there's so many companies that IPO and they IPO at a decent price, and then within a few months or a year, they just dip and they just
Yeah.
absolutely tumble. So just make sure you're very confident. You've been keeping track of it, that kind of thing, just because it's tough when it's a younger public company compared to something that's been a little more established, like Matt was talking about, where you can kind of follow the results and kind of see where the trajectory is going.
Yeah, totally agree. All right. Thank you, Dom. Thank you, everyone.
Thank you.